Well, there's something deliciously ironic about markets at the moment. After years of load shedding and fiscal anxiety and all the political soap operas in South Africa and the occasional bout of rand induced vertigo, we do find ourselves in relatively decent shape. Inflation certainly subdued around the 3% mark. The currency quite strong on the back of a weaker dollar this year. Bond yields very attractive in looking at our 10-year yield back below where it was around 2018 before COVID. And suddenly the global backdrop is also being described as something of Goldilocks, not too hot, not too cold, just right. Of course, when markets feel like this, often investors can mistake a cyclical reprieve for a structural renaissance. So today we're going to take the long lens and we're going to ask what's really happening beneath the surface in South Africa, globally, and also inside portfolios. And joining me is Malcolm Charles, portfolio manager at 91. Malcolm, great to have you on the show. And if we were to zoom out firstly, I mean, if you compare today to early 2024, how materially different is our starting point?
Sure. If you go back that far, a hang of a lot. So if you think of where we were back then, we were in the wilderness a little bit politically. The country didn't really hold out much hope. Reform was minimal. And there was a nervousness around emerging markets in general. There was a lot of nervousness about South Africa. And all the focus investment-wise was in America. That's where the growth was. That's where there was yield. And investors really weren't interested in investing anywhere but in the States. And we were nowhere. But, then we had our elections, the GNU. We've had pretty decent reforms. And believe it or not, we've done more right than wrong for the last probably 12 to 18 months. And I think we, now quite rightly so, seeing the benefits in our markets.
Yeah, I mean, if you think about it, S&P upgraded their rating for the first time in a long time. We got off the FATF grey list. Last year, I think, was the lowest for load shedding that we've had since load shedding began. Even Transnet is showing some signs. I saw the latest numbers saying an 11% improvement in railed coal out of Richards Bay. So, I mean, that's not just rhetoric. These are real hard numbers showing that we're not scoring the own goals that we used to, Malcolm. Looking at the rand, is it right then that it has surprised a lot of people with its resilience, or is it still just a factor of this dollar weakness, dollar debasement trade that we've seen around the world?
The nice thing is a bit of both. So you can't deny that last year was anything but the dollar. You really didn't want, I mean, I think only 3 or 4 currencies underperformed the dollar. And emerging markets in general did very, very well. We were only number 7 or 8 on total performance if you look at the emerging markets out there. And so there was that weak dollar theme. Was probably, I would say, 50-60% of the driver. But then when you actually unpack the rand as well, there was rand strength. In the equation as well. And that's because of the terms of trade. In terms of trade, very simply, what we export divided by what we import. And that implies roughly a 15.50 rand dollar exchange rate if you take the current gold price and platinum price and the current oil price. So we are benefiting from it. The fiscus is doing very well as a result, and they're going to do even better in the new fiscal year because of the taxes that the mining companies will pay, the royalties that they will pay, and that's all been factored now into the currency. So it's a good place to be for the currency. That is not you're not just a price taker. There is some South African strength in there as well, thanks to our commodity prices and the boom that we've got there.
Yeah, I must say, after a chat with Rene Hochreiter, who I regard as one of the top PGM analysts early last year, I decided to take a nibble in Valterra at just over 800. And it's just been an absolute tear. We've seen PGMs, precious metals, come off a little bit recently, but you can't deny. I mean, gold through $5,000 an ounce, and where platinum and palladium have gone through 2,000 as well. But coming back to the rand, it's important for a number of reasons, but one of those is imported inflation, isn't it? Because a stronger rand means we import less inflation. Inflation has moderated meaningfully, and the Reserve Bank has wanted to anchored around 3%, this new target now. And it's given households breathing room, and it's obviously given bond investors a lot of comfort. You look at that 10-year below 8%. So what does that mean then for the Reserve Bank over the next 12 to 18 months? Are we looking at a continuous cautious cutting cycle, maybe a bit of a pause at the start, or something more nuanced in between?
Yeah, I think they're in a fantastic look at. I think hats off to Lesetja and his team. They've done a fantastic job at the SARB of anchoring inflation and driving the debate to get the target at 3%. And expectations have fallen quite dramatically since the announcement was made. So we saw 3.6 in December inflation. It comes out again this week. Consensus I see is 3.4. So the high is in place. I mean, and the high is 3.6. I mean, it's not often that you've looked at inflation in South Africa and gone, shucks, it peaked at 3.6%. Normally that's the bottom, and we're jumping up and down. So we've got the forecast for this year averaging about 3.1% for the year. So spot on in line with the SARB's target. And hence, we are calling for a rate cut as early as March. There were a couple of people calling for one in January. I think that was a little bit early, knowing the cautiousness of the SARB. But we think March and probably July, we should get another one, which, as you said, will be a further boost to the consumer out there. Imported inflation a little bit lower, so a little bit more money in people's pockets. And that then will start showing up in the growth numbers and the spending numbers for the broader economy.
Yeah, I mean, the South African economy is still something like 60% driven by consumer spending. So interest rates are important. They don't just affect mortgages, they affect confidence, retail confidence, and they also shape asset allocation decisions across the board. I want to come back to the budget, though. And you said, obviously, we're going to have an upward surprise. Enoch Godongwana is probably being, very cautious about how he frames it in the build-up to the budget. But I'd be surprised if we didn't see a material uplift given those precious metals gains. So what are you going to be looking for? What would constitute a genuine upside surprise? Are you going to look for more of that primary surplus discipline? Maybe more structural reform acceleration, and maybe on the other side, what would make you nervous given that the budget is around the corner?
Yeah, so those are all intriguing questions and something that we've been spending a lot of time on. So we expect that there could be upwards of 20 billion extra revenue in the numbers for this fiscal year. Next fiscal year, it's even more exciting. The numbers, 3-4 times that. He's unlikely to show his hand of that yet, because the last thing you want to do is show politicians that there's lots of money because they want to spend it. So I think we will continue to see a conservative response from National Treasury and the Minister. So we think there will be upward surprise. I think what it could lead to is some fiscal drag adjustment, which we haven't had for a couple of years, which means a little bit more money in consumers' pockets on top of the rate cuts. We saw a cut in issuance in November. We think that if this trend continues with the commodity prices, we could see a further cut in debt issuance in November this year. You just seen what should be very positive is that our debt to GDP number should have peaked. We've always been saying it'll peak in 3 years' time. In our calculations, it has now peaked. So that is very, very positive for the rating agencies for the remainder of this year. And there could be upward shift from those agencies later in the year. So we want to see a continuation of the spending discipline that they've shown. And from a structural point of the budget, there's been quite a bit of talk of a fiscal anchor. In other words, a rule-based to protect us from politicians running a little bit awry with spending in future years. So I think there will be another constructive budget from the minister, utilizing the windfalls to get our debt under control, to get the issuance down, all the right things, so that the country's in a better place for years to come.
And for me, it's about that credibility as well, because to your earlier point, where we would be losing credibility, it's always about projecting debt to peak and then come down, and that was pushed out and pushed out. And the more you push that out, the more you erode credibility. And that credibility isn't built in the speeches, it's built in the numbers. And those numbers really are starting to show a material improvement. It's a great position to be in, given where we were, as you said, just 2 years ago. If you look globally, though, we're still a small open economy. I was going to say a large open economy. We're still fairly small open economy in the global scheme of things. So what happens globally matters. You've described the global backdrop as Goldilocks. So unpack that for us. What makes this environment neither too hot nor too cold?
So the two elements you look at is the growth and the inflation. And what you want as an emerging market. So as you quite rightly said, we price takers. We can do everything 100% correctly. If the global theme is not in favor of emerging markets, no one will come buy debt and buy equities. So what you want is growth that's not too hot, not too rampant, that all the money then goes into that economy because you're chasing growth. If growth is 4 or 5% in a global market, everyone will then put their money there to benefit from that growth. So you want a more muted growth, but still in the right direction. And equally, you want inflation to be okay, under control, so people aren't defensive and sitting in cash. So you're not going to have an environment where the Fed or ECB are hiking rates, because that will actually just once again attract capital away from our markets into those markets to utilize the better yield. So, and that's what we've got in the US. You've got okay growth. You've got inflation that people were scared of this time last year, but it hasn't really manifested as high as the fearmongers had it. And there's talk now of a Fed cut in the next couple of months. So cash is a little bit unattractive in dollar terms. So naturally you go, okay, where can we go? Where can we get a decent yield? Where can we get a very attractive real yield? Because even though our rates have come down, our real rates are still very attractive due to the 3% inflation that we expected this year. So, they look at emerging markets in general, and you've seen a lot of interest in emerging markets. Our London team is out there, and they get inquiries from all different geographies. Can we invest into your products? Can we invest into these markets? And South Africa, in that emerging market environment, is a very attractive proposition. We've got one of the highest real rates. We've got a very free-flowing currency and easy market to access, a very deep and liquid bond market. So we tick all the right boxes when the theme is towards emerging markets. And that's why we are benefiting so well. And just last month, over 30 billion rand came into our bond market from foreign investors.
And it's a remarkable turnaround. And if you had given investors what did we deliver on the Swix 50% return last year, they would have bitten your arm off. But what you're describing is that this momentum can continue, because a lot of that, I think, was also driven off the back of precious metals, and we didn't see that much global interest in our market. That is starting to turn. So let's talk portfolio construction then, in an environment where returns are likely to be maybe more modest but still attractive. How are you balancing income generation, your duration exposure, and downside protection? Are you leaning into bonds given that yields remain compelling, or is equity risk still justified in this environment?
Yeah, so in our diversified income fund, the only equity we can have is listed property. We increased that towards the end of last year because property had actually lagged the bond market, and we all know that any property investor keeps their eye on the bond market because there's a strong correlation between the two. So we still line listed property. We still think those stocks are well priced. Their dividend yields are attractive, and the potential for growth in this environment is actually quite strong for the year for those stocks. But in the bond space, that's probably where most of our risk is positioned. And there it's been quite important to be in the right part of the yield curve. The short end is very well priced for the rate cuts already, so there's not much yield there, whereas the long end of the curve was where all the South African discounts was priced. So all the fear factor about the GNU not working, all the fear factor, just about things going wrong in South Africa, about some of our political decisions not that good, was anchored in that long end, and that is now starting to show very, very good movement and is outperforming. So if you're in the long end of the curve, you've outperformed all the other parts of the bond market, and we still think that there's a little bit of fat in that part of the curve. Having said that, the market has done fantastically well over the last 12 to 14 months, and it's not nearly as cheap and obvious to buy. So we remain constructive, but a little bit cautious. So that's why we put some protective strategies into the portfolio. We bought some protection should there be a little craziness from whether it's Trump or our politicians or something like that. And we know that can happen. So the dollar's not working very nicely as a hedge. So we've bought a couple of euros, and we bought some option strategies in the portfolio to protect us should there be a little hiccup in the market.
Yeah, and as we saw just recently with the announcement of Fed nominee Kevin Walsh, there was a bit of a wobble on the back of that. Is he the hawk? Might he have had a dovish Damascene moment? What is he going to do with the Fed balance sheet? Now, when it comes to the behavioral risk, you've warned that the biggest risk might actually be behavioral, given what we've just experienced. And I think the temptation in calmer markets is to stretch for yield or to reach for a bit more risk. You're saying, actually, we've bought a bit of downside protection. So what would your advice be for viewers watching this? Because investing success is often less about predicting the future and more about just managing ourselves at the end of the day.
Yeah, I think that the trick is, don't look at last year's performance and think it can be replicated. I think that's probably the biggest mistake investors make. Understand that markets have priced a lot of the good news in, but then also understand that, yes, bond yields are lower and equities are a little bit more expensive. But as I said right in the beginning, inflation is going to average 3% this year. So your hurdle is lower. And, if you look at the cash rates, we think at least 50 basis points of cuts this year. So your cash rate's going to be low. So be very careful of going, okay, things have run, I'm going to go into cash. You're actually going to have a very muted return from cash out there. So therefore, bonds are actually offering you a decent pickup in yield. As long as you can, be in a fund that has got some sort of protection strategy for the unpredictable risk out there that could happen, typically from a politician or something like that. So I think, manage your expectations, manage your risk, but knowing that your hurdle is lower, you still need to be exposed to the market to get some sort of decent return and a real return for the year.
Absolutely. Malcolm Charles, thank you very much. Portfolio manager at 91. Certainly, if there's a thread running through the conversation, it's that we may be in a better place, but it doesn't mean you get to be complacent, because markets have a way of humbling all of that certainty. And remembering as well that patience isn't a passive strategy, it's an active discipline. You've been watching Business Talk on businesstech.co.za.